biggest market threat in years, warns SocGen's Albert Edwards, because Japan's bond market just flashed a 2007-style signal that could yank billions out of U.S. stocks. Yes, even your 401k. But here's the good news. Lazy investors like you can bulletproof your portfolio in minutes. Stick around, I'll show you how. For decades, Japan's bonds paid nothing. 0.1% yields were normal. That forced their pension funds to chase returns in U.S. stocks, treasuries, and even real estate. Now, that tide is turning fast. Japan's 10-year yield, 1.6%, up from 0% in 2021 30-year, 3.18%, highest since 1999. Think about it. If your bank suddenly offered 5% on savings, would you bother chasing risky, volatile stocks? That's the trap. Think of bond yields like a sale on government loans. When Japan's sale jumps from 1% to 3.6%, suddenly their discount beats everyone else's. So big players like pension funds pull money out of U.S. stocks and bonds to buy Japanese debt instead. Result? Fewer buyers for U.S. assets. Stock prices feel the pressure. Albert Edwards calls this a market threat for two reasons. One, U.S. stocks are expensive, especially tech. If Japanese cash leaves, valuations could drop. Two, the equity risk premium is shrinking, meaning stocks aren't paying you enough extra versus safer bonds. But before you stress sell your index funds, this isn't 2008, it's a normal capital shift. You're a long-term investor, time is your superpower. 3. Lazy investor fixes. Step 1, the 5-minute portfolio health check, open your 401k. If you're greater than 30% in tech, QQQ, VGT, shift 5% to Dividend tanks, SCHD, short-term Treasuries, SGOV. SCHD is a dividend-focused ETF, more stable, so if tech sells off, you have some anchor. SGOV tracks short-term Treasuries, so you're not getting whipsawed by long-term bond volatility. Obviously, if you shift 5% out of tech, you might miss a further tech rally, but that small buffer can be the difference between a 5% drawdown versus a 15% drawdown on the next sell-off. Step 2. Set a fear buy alert. Pick 2 ETFs you own, e.g., VTI, VXUS. Set a limit order 10% below today's price. In your brokerage app, find trade, select your ETF, then choose limit order and input a price that's 10% below current. Save it, and it will execute automatically if the price dips. Step 3. The coffee money. Hedge every Friday, buy $10 of FLJP Japan Equity ETF. If the yen rebounds, you profit. If not, it's coffee money. What not to do. 1. Don't sell just in case. Transaction costs plus taxes will murder your returns. If you panic sell because headlines scream, you'll walk right into that trap we talked about, selling low and missing the bounce back. 2. Don't buy gold crypto. This isn't inflation panic. Gold typically rallies on inflation, not yield shifts. Crypto? Pure speculation. Both can whipsaw you faster than a bond-driven rotation. 3. Don't obsess over CNBC. They profit from your stress. Remember, Japan's move is a speed bump, not a cliff. The lazier you are, the more you win. Every week, I decode market noise so you don't have to. Drop us in the comments if you're staying lazy and hit the subscribe for next week's report.